If you're already investing in multifamily, you probably know how to calculate a cap rate, but here's the problem. A good-looking cap rate doesn't necessarily mean you have a good deal. Before I would recommend making an offer on an apartment building, there are five numbers I want to understand, and the fifth one is the one many investors overlook. The first number I want to know is the property's actual net operating income, not the seller's projected NOI, not the broker's pro forma. The actual NOI the property is producing today. I want to see the trailing 12-month operating statement and compare it to the current rent roll. Then I want to determine whether the income and expenses are realistic. Because if your starting NOI is wrong, everything downstream in your analysis is wrong. Your cap rate is wrong, your valuation is wrong, your financing analysis is wrong, and ultimately, your offer price could be wrong. The second number I want to know is the gap between actual rents and market rents. This is where I start looking for the value add opportunity. Let's say the property is currently averaging $2,000 per unit, but comparable renovated units are achieving $2,300. That $300 difference could represent significant additional income. But there's an important question. Can you actually achieve that $300 increase? You have to consider unit condition, tenant turnover, renovation costs, local competition, and how quickly the units can realistically be repositioned. Don't put $300 of rent growth into your spreadsheet simply because a broker told you the market supports it. Prove it. Number three is expenses, and this is where I see investors get into trouble. A seller may have an unusually low expense ratio because they've deferred maintenance, self-managed the property, have favorable insurance, or simply haven't spent the money necessary to operate the property properly. Your expenses as the new owner may be very different. I want to look carefully at property taxes, insurance, utilities, repairs and maintenance, property management, and capital expenditures. Then I ask, what will these expenses look like after I own the property? Your goal isn't to make the expenses look as low as possible. Your goal is to make them realistic. Number four is the purchase price. But I don't mean simply asking, what's the asking price? I want to know what I'm actually paying relative to the property's income. For example, if a building produces $250,000 of realistic NOI and you're paying $5 million, you're buying at a 5% cap rate. But if your corrected NOI is actually $225,000, you're really buying at a 4.5% cap rate. That's a very different investment. This is why I always recommend calculating the cap rate based on your own underwriting, not simply accepting the seller's number. And this is the number I think intermediate investors should pay much more attention to: return on your equity. You can own a property with a perfectly respectable cap rate and still have a disappointing investment if you're putting too much equity into the deal. Let's say you invest $1 million of your own money into a property. If that property produces $50,000 of annual cash flow after debt service, you're earning a 5% cash-on-cash return. Now compare that with another property where you invest the same $1 million and generate $70,000 in annual cash flow. That's a 7% cash-on-cash return. The question isn't simply, is this a good property? The better question is this the best use of my equity? That's the question experienced investors should be asking. There's one more thing I would do before making an offer. I would stress test the deal. What happens if rents don't increase as quickly as you expect? What happens if insurance increases? What happens if your renovation costs are higher than expected? What happens if you have a higher vacancy rate? And what happens if you eventually sell at a higher cap rate than the one you used in your original projection? If the investment only works when everything goes perfectly, you don't have a great deal. You have a great spreadsheet. And those are two very different things. So before I make an offer on an apartment building, I want to understand five things: actual NOI, current rents versus market rents, realistic expenses, the price I'm actually paying, and most importantly, the return I'm getting on my equity. The goal isn't to find a property that looks good on paper. The goal is to find a property that still looks good after you challenge the assumptions. I'm Mike Lembeck, and if you're an apartment owner or multifamily investor, subscribe to the channel. I cover multifamily investing, apartment valuations, and the Southern California apartment market every week. And remember, the best deal isn't necessarily the property with the highest return. It's the property where the return justifies the risk.